Joining me now is Michael Ranking. He is the senior market strategist at the New York Stock Exchange. Michael, welcome to NYSE Live.
Morning, thanks for having me.
All right, so we're about 30 minutes away from trading. What are you going to be following today most closely during the session?
Yeah, I mean, look, with the holiday kind of upcoming, right, where you're going to see attendance and volumes kind of trail off a little bit, right? We're coming off of kind of pretty strong 3 days of gains, kind of in the markets after we've had kind of a tough month, as you just pointed out, in November. This morning we got kind of the claims data, which came in pretty solidly. Continuing to highlight that kind of the hiring, kind of hiring is slowed, but we're also not seeing kind of these mass layoffs, right? And so you have a labor market that is slowing, but not necessarily kind of deteriorating, really quickly, and then kind of obviously we're kind of focusing on the Federal Reserve. There were reports yesterday that Kevin Hassett has now kind of become the front runner, to replace Fed Chair Powell, and that was part of the move that we had seen in yields yesterday. And helping equity markets move higher.
Speaking of the Fed, the markets seem hyper-focused on another Fed rate cut, and the trader confidence in one has jumped significantly in the past few weeks. What do you think is fueling that confidence?
Yes. So, a lot of the equity volatility that we've seen over the last couple of weeks is revolving around kind of the expectations for those rate cuts. And we're seeing a very big divide, kind of on the committee in terms of where kind of they see the path of monetary policy going forward. Now, we got a lot of hawkish commentary at the beginning of last week, with people kind of highlighting that inflation is remaining above target, right? Concerns about kind of cutting into that environment. And then on Friday, we had New York Fed President Williams, John Williams, who is part of the Fed's troika. So think about it like the top leadership at the Federal Reserve, the chairman, the vice chair, and then the New York Fed president. He came out and had suggested that he saw further easing and further room to kind of cut rates in this current environment, and that was taken. Any kind of communication he has with the street, right, is viewed by Chair Powell before he actually kind of speaks, right? So him suggesting that he supports a further rate cutting, suggests the top of house does as well. We saw the probabilities in terms of of a December cut go from about 1 in 3 to almost 80% as of yesterday, following his commentary, right? And then you also kind of adding to that, the idea of Kevin Hassett, who is viewed to closely align with the White House, right? That also put pressure on yields, or on pushed yields lower, right? As he's viewed to have kind of a more dovish kind of stance.
All right, and more economic data is rolling out. You mentioned it, when we first started talking. On Thursday, we received PPI data, U.S. retail sales. PCE data will be released on December 5th. How heavily do you think the Fed will be weighing these delayed September reports in that December meeting?
Yeah, so I think that's kind of really the difficulty, right, in that all of this data that we're seeing right now is pretty stale, right, and it's all kind of government shutdown data as well when you think about it from that perspective, right? So we're not going to get the next round of major economic data until after, the Fed's next meeting. So I don't think they're necessarily kind of weighing it all that heavily. Look, I think there's kind of two ways. Markets are telling you that the Federal Reserve is going to cut, right? You heard, that commentary that we just talked about, but there's two ways this can go. They can either cut and then kind of have it be a hawkish cut where they kind of suggest that the bar for further rate decreases gets much higher after cutting, or they can kind of do this dovish hold where they leave rates unchanged, say we're going to get so much economic data between the December and January Fed meeting, right, that would be a better time period for us to kind of make adjustments to monetary policy. I think that's the easier messaging of the two. Markets would not take that particularly well. And it does seem like markets, they don't like this. Fed has not wanted to surprise markets, so it does seem like we're moving in the path of a rate cut in a couple weeks.
All right, and the S&P 500 has gone up about 13% over the past year. Do you think we're going to see it hit 7,000 before the end of the year?
Yeah, I'm not going to make any proclamations. I think that would be kind of in terms of 7,000. That seems like a bit of a stretch from from here, especially kind of with the reset that we've had. Right. If you look at kind of historically, December is kind of viewed as a positive time period for equity markets. If you and over the last 50 years or so, right, that has been the case. You're looking at kind of average returns of a little over 1%. Markets have been up about 75% of the time in that month of December. If you look more recently, though, right, the return profile is not quite as positive. Over the last 10 years, right, December's got a slightly negative average return profile. Over the last 5, it's a little bit more positive, but we've only been up a little over half of the amount of time. So that December seasonality doesn't necessarily hold, kind of in more recent time periods. And then something that we had talked about, more recently, is that when you buck the trend of weakness in August and September, right, Q4 doesn't tend to be as strong as when those time periods are lower because you don't have as much ground to make up, right? And so that's kind of what we've been seeing, really in Q4, kind of up until this point, where we're kind of hovering, kind of slightly higher, over the at least the first 2 months of that time period.
All right, Michael Reinking, Senior Market Strategist at the New York Stock Exchange. Thank you for joining us.
Thanks for having me.